China's 2025 market boom faces sudden turbulence due to tariff tensions. What was once one of the brightest years for Chinese stocks is now overshadowed by fears that the trade peace between Washington and Beijing could quickly collapse. Global markets rattled on Friday evening after U.S. President Donald Trump announced a 100% tariff on all Chinese imports starting November 1, along with new restrictions on critical software exports. The escalation came just days after China restricted exports of rare earth elements, a move the White House called economic blackmail. The result was an immediate flight from risky assets. The benchmark index of U.S.-listed Chinese companies fell more than 6%, the sharpest decline since April. Nvidia, already at the center of the chip war, lost nearly 5%. The Australian dollar and other Asian currencies weakened as investors sought refuge in safer assets. The headlines alone will be enough to rattle investors before Monday's opening, said Haris Khurshid, CIO of Karobar Capital LP, who expects a wave of risk aversion in Hong Kong and Shanghai. So far, the rally in Chinese stocks in 2025 has been exceptional. The Hang Seng has risen 31%, driven by optimism about artificial intelligence and the prospect of a trade truce. Giants like Alibaba and Tencent have doubled their value after 4 years of declines. Now, analysts warn that geopolitical shocks could slow the recovery. Beyond stocks, the yuan is also under close scrutiny. The currency has strengthened by about 2% against the dollar in 2025, but a prolonged conflict could reverse that trend. Traders will be watching the next People's Bank of China rate fixing to gauge how much volatility Beijing is willing to tolerate. Meanwhile, long-dated Chinese government bonds rose on Saturday, with the 30-year yield declining at its sharpest pace since April, a sign of a search for safety. Despite the turbulence, some economists see Trump's announcement as a negotiating move rather than a definitive change of course. This escalation seems like a high-risk signal ahead of the Trump-Xi meeting, said Hao Hong, CIO of Lotus Asset Management in Hong Kong. Markets will falter, but the long-term trajectory of Chinese assets could hold if diplomacy returns to the forefront. China's Ministry of Commerce called on Washington on Sunday to halt tariff threats and return to dialogue, calling its export restrictions defensive and necessary and aimed at protecting national interests. Investors remain cautious. Barry Wang, portfolio manager at Oberweis Asset Management, warns that valuations have already outpaced fundamentals. The rally needed to cool. Even without the tariffs, prices were overheating. Next week will tell whether the Chinese market miracle was the result of temporary optimism or whether it is solid enough to resist the return of old geopolitical ghosts.